Welcome to India Charts. If you have been a long-term reader of India Charts or if you're new, it's very important that you understand the basic guidelines of uh, the principles on which all the research and forecasting has been built. The base, of course, is Elliott Wave Analysis, but we've taken it much further to combine it with long-term economic cycles and fundamental cycles. And in this video, I'll take you through a brief of all of that and cover the essential basics of Elliott Wave Analysis that you should be comfortable with when you're reading any report or any update that I put out. This is important because sometimes I write in a little technical language, although I always try to mention very clear-cut targets and reversal levels that can be used when you're actually building your trading strategy in terms of setting where your stops need to be or where you need to look for booking your trades. But you also need to know in what context I'm talking and the importance of a third wave or a second wave and what it can mean in terms of the view remaining in force or changing. Once you get an idea of the structure, then you know that whatever degree of time I'm discussing, what is it that I'm really talking about. So without getting into further detail, let me kickstart by first covering the basic principle. Now, I'm not going to go into a great detail of everything here, but the Elliott Wave principle is based on the work done by R.N. Elliott, where he discovered that there was a repetitive pattern, and over time, as it's been handed down, it was taken up by Robert Prechter, whose books allow us to pick up the classic Elliott Wave counting methodology. And the reason that we all believe it works is that it captures mass human psychology, that is a mass of people herding. Their behavior tends to be the same when they are exposed to the same external stimuli, and that repetitive behavior or similar reaction to the environmental changes is what shows up in the Elliott Wave fractal or the Elliott Wave form, which is thus reflected in prices of especially key indices, which represent a large mass or a large market cap, which has as an underlying a large mass of people who are trading or participating and reflecting their emotions through their buyings and sellings. And thus the principle of course shows up beautifully on indices, but it does so well in highly liquid stocks or other securities as well. So without much more detail, let's look at exactly what this fractal is all about. The repetitive price behavior that we see in securities or stocks and indices essentially takes a 5 and 3 form. The prices tend to move in 5 waves in direction of the major trend and 3 waves against the major trend. So if the major trend is up, then the fractal shows up as 1, 2, 3, 4, 5 on the way up and ABC on the way down. And when the trend tends to be down, then the fractal shows up as 1, 2, 3, 4, 5 down and ABC on the way up. This tends to repeat at all degrees of time, whether you're studying quarterly, monthly, weekly, hourly, 15-minute, whatever time frame you choose, this fractal tends to repeat at all degrees of time. And I'll try to explain now what we mean by all degrees of time. So if we are looking at, let's just presume that we are looking at a daily chart and we see the development of 1, 2, 3, 4 and 5, and then we get an ABC. What happens next? So essentially the sheer existence of that you spotted 1, 2, 3, 4, 5 means that the trend is in that direction. Now this is especially true if it's happened after a trend that was in the other direction. So if you had prices falling for a considerable period of time and suddenly you ended up seeing 1, 2, 3, 4, 5 on the way up after a fall, then it would amount to a trend reversal. Now one of the key important facts about this pattern is that you notice that there are a minimum 3 waves, which means A, B, C or 1, 2, 3 but in the direction of the trend it goes on to say 4 and 5. Now because you always do have a third wave, what it means at a higher degree of time is that if you've seen a 1 2 3 4 5 ABC pattern at a larger degree of time, it means that the trend is likely to continue. It's definitely not over, and you will get another series up from there. Now this is what allows you to take high probability calls when you're able to spot clear wave structures. You know what's coming next once you've seen the initial design of mass behavior. Now if the overall trend at a larger degree, if you had a view that the markets are still bullish, then you would expect one more leg up. So here's the reason why. I just mentioned that you see a trend to occur at all degrees of time, which means that 1 2 3 4 5 at a higher degree would be the first wave. It would be wave 1 of a higher degree. You'd get wave 2. Similarly, you would end up getting wave 3. If the bigger trend was still up, you'd get wave 4, and then you would end up getting, at the end of it all, wave 5. And this is how at a higher degree of time you still have you have a larger 1 2 3 4 5 structure developing. So what we spend as Elliotians a lot of our time doing is looking at various charts and updating our markings across charts and indices on a daily basis to see how this fractal is developing, and it keeps telling us on an ongoing basis what is changing. So when somebody asks, and we have alternate counts or counts change, somebody asks, then why does this whole thing really work? The answer is yes, because like I mentioned, because we know the possible structures that can form. There are only so many structures that can form in a 1 2 3 4 5 ABC, that it gives you a certain probability of what is likely to come ahead. Even if something changes, you are able to quickly determine that something is changing, something unusual happened, and therefore you're supposed to change your view. What could be unusual? If you got something looking like 1 2 3 4 5 in wave 1, as I've shown over here, then wave 2, as a rule, and one of the first rules of Elliott Wave are that wave 2 should not go below the starting point of wave 1. So moment you see this kind of structure, you know that you are stopped to this view of a further move up, at least in a third wave, is the low point down here, and unless that is broken, you're likely to get another series of 1 2 3 4 5 on the way up. So that's the first rule, first guideline of Elliott wave counting, and it's these guidelines that allow us to eliminate the wave counts that are not possible. And in that sense, I've just answered that Elliott wave counting is essentially the art of elimination. It's the art of eliminating what is not possible, so that you're left with the least, the smallest number of possible outcomes, and then you're dealing with those few outcomes and trying to generate the highest probability trades with them. Now combining that with various other tools that technical analysis provides you is a further help in increasing the probability of which wave count to choose out of the 2 or 3 that you're left with. And that's where sentiment indicators and momentum indicators also come into play, and that's why I call whatever I write as complete technical analysis, that you've studied all the factors that come into play in a technical trend. And so taking this a step further, what happens when we are looking at a counter trend? Now, like I said, after you complete 5 up, what you're essentially looking for is a counter trend on the way down. Now I've shown in this structure that it looks like after you completed 5, you do a simple ABC down, but a very detailed structure would look something like this. When the larger trend would be down, what you would expect is again an impulse on the way down, which then you would mark as A. The subsequent upward move would be 3 legs, because that would be against the broader trend, and you would end up marking that as B. And then the next series of 5 down, you would end up marking as C. And this would complete a larger 1, 2, 3, 4, 5 ABC structure at one higher degree. And this goes on. This larger 1, 2, 3, 4, 5 would be a larger 1 and a larger 2, and so as this goes on, we end up with trends that are cycle degree, super cycle degree, grand super cycle degree. And to make that sound simple, what I would say is cycle degree is essentially what you see in the 3 to 5, 10-year time horizon bull markets and bear markets that occur of cycle degree. The super cycle is essentially a generational cycle, which is the Kondratieff cycle, in my understanding, is the best representation of a generational cycle, which used to be 40 to 50 years, but as time has progressed and people age longer, they live longer, the generational cycle expanded to 70 years, and now it might be as long as 90 years. So there's no fixed time frame to the generational cycle. It would vary as per the aging of society, the length at which people are aging, and their behavior over the years that generates a larger 5-wave trend pattern that develops over a 70-80 year time frame, which is what I call the Kondratieff cycle. And then there's the grand super cycle, which would be a series of 3 impulsive super cycle bull markets over 70 years each, and then bear markets in between of 10 to 15 years. So you're really talking about something approximating 300 years is what you call a grand super cycle. And if any of you have really read the works of Elliott Wave by Robert Fractal, where he talks about the US ending a grand super cycle, he's really talking about it ending a 5-wave on a 300-year time frame based on his study. So we are looking at different, we all look at different time frames. India, because it was, it gained independence only as early as in the 1940s, and the RBI came into place only in the mid 30s. That my consideration is that we are in the first super cycle as far as India is concerned, and not at the end of a grand super cycle, but all the same, we are at the end of a super cycle. Now, that said, this is the simple structure of what an Elliott wave pattern shows on any chart that we are looking at and in any time frame, and it keeps building in. So it's a lot of work, it's not that simple. And with that, let me cover all the 3 basic guidelines of Elliott wave analysis. I've already covered the first one, where wave 2 can never go below the starting point of wave 1, so that when the first impulse develops, the stop loss really comes in at the bottom of wave 1, which is down here. It cannot really go below the low that formed there, and that becomes the first stopping point. The initial wave 2 often tends to retrace a lot more, 50, 60, 80%, and therefore the wave 2 low becomes a good support at the minor degree, which is somewhere down here. You get a minor degree support in the first correction. The second guideline of Elliott wave counting is that the fourth wave cannot go into the price territory of wave 1, which means the low that forms in the fourth wave at point C should not go below the high of 1. And if it does, then we can no more mark this as 3, 4. It would have to be something else. Now that's the second guideline that allows us to often eliminate a lot of counts. If people are marking 1, 2, 3, 4 and it's and the waves are overlapping, it can't be 1, 2, 3, 4. It's either an extended wave where you'd have series of 1, 2, 1, 2, or it would be a corrective ABC. So many times we are able to rule out a potential impulse in a corrective market or in a range bound market. Moment it overlaps, we look at the risk that something else or might be unfolding, and the chances of it going back and breaking the previous low exists moment you get an overlap, and that allows you to do some kind of risk management in your portfolios by reducing your positions and actually looking at what's going on. Now let me highlight here another important fact, since a lot of people try to do wave counting on different types of charts, but when you think of the basic principle that the wave structure is supposed to show up on all degrees of time, and it keeps subdividing at a smaller and smaller degree in fractals. That means that if wave 4 and wave 1 are not to overlap, they are not to overlap at any time degree. which means that if you're even using a line chart and you can say, oh well, it didn't overlap on a line chart and that's good enough, my answer is it's not. I really prefer using bar charts, a lot of people don't answer this question clearly, whether you should be using line, bars, candles, but the essence is that every high and low of any time period is important, because the wave 4 is not supposed to overlap wave 1, and if the fractal repeats itself at every time degree, then that means that they are not supposed to overlap up to the high and low point. Otherwise it would be an overlap at a lower time degree, because moment you'll go to a smaller time frame, you will see an overlap even on a tick chart in a line. So should you really ignore something because it occurred in a different time frame? The answer is you can't, and therefore I think the highs and lows made by bars are probably the most accurate when it comes to looking at overlaps. And so I essentially discard most line counting or simply candle counting, or even trying to count in between points on dojis, and which is mostly your imagination. So it really requires you to work on multiple time frames and see that what you're thinking really exists at every level, and therefore it's a lot of work. Now that takes me to the third and most important, another very important principle, and that is that the third wave of the pattern cannot be the shortest. Now it's very important you heard those words very clearly. I said the third wave cannot be the shortest. A lot of people write in saying, well, it's the third wave, it's got to be the longest. That's not the rule. The guideline that was originally written was that it's not the shortest. Now, yes, third wave tend to be the most powerful, because by the time you're in wave 3, everybody realizes what's going on, or the fundamentals are more apparent, especially at cycle degree, and therefore most momentum trading comes in there. Most fundamental reports in favor of the underlying stocks actually get written at that point of time, because everybody is convinced about what's going on. And so third waves tend to extend or become large, but that's not theory, and especially at lower time frames when smaller degree patterns are forming, sometimes the third wave can actually be shorter than the first. That does not mean it's not a third wave. If it didn't overlap with wave 1, then it would still be a third wave, but all it means is that the fifth wave then is essentially going to be still shorter, because if the fifth became larger than the third, then it would violate the rule that the third is not supposed to be the shortest. And so this again, as a very basic guideline, allows you to eliminate a lot of counts and possibilities. If you did end up with a third that was short, and then the market actually extended, that is the fifth wave became larger, then you know that the count is no more 1 2 3 4. It would be an extension of the third wave, so you would end up marking 1 2 1 2 3 4 3 4 5 as a much larger subdivided fractal, and it will also allow you to eliminate a lot of counts that are not right, because the moment you will see a third wave short in something that you marked 5, you can eliminate it, and that allows you to come down with a fewer and smaller number of alternate possible outcomes from the market. And that's the whole objective of using these basic guidelines for counting to do Elliott wave analysis, that you eliminate using these three basic guidelines that you find in chapter 1 of Elliott wave principle. You can eliminate so many bad alternate counts that you would be left with very few, and then it becomes much easier for you to come down to what is the best possible choice of those outcomes to trade with. So these guidelines also allow you to have the right stop losses. For example, if you are marking wave 4 and you get an overlap, once you are into third wave, you are able to raise your stop loss to the high of wave 1, and an overlap would actually rule out the possibility that you were in third wave or something else is happening, or maybe it's an extension. So it allows you to deal with those risks. If it's an extension and it's still going to go up, you need to adjust your portfolio accordingly. It doesn't always mean you go to zero, but as a market develops, as we get different readings, the probability keeps changing, and wherever you have a trade, an open trade, you need to keep adjusting the size of your trade, especially if it's leveraged from maybe 500 shares to 300 shares to 200, then back to 400, depending on what the market is doing. And that's what forms an active trading strategy. You cannot really be, if you're a trader, you cannot really have a fixed strategy. You need to be dynamic, and these tools allow you to be dynamic. So I hope you've understood the essence of what Elliott wave patterns look like, and why we count the way we do. And so the next time I'm writing about targets and stop losses, you know why I've put them at those places. To sum up quickly, the three cardinal rules: wave 2 never moves beyond the start point of wave 1, wave 3 is never the shortest wave, and wave 4 never enters the price territory of wave 1. Now, like I discussed just a few minutes back, that the Kondratieff cycle forms the super cycle degree wave count, which occurs at a generational level, which means approximately 70 to 90 years in time. This theory was originally looked at by Nikolai D. Kondratieff, who was a Russian economist, and due to his work he was imprisoned because the Russians thought that he was a capitalist, but his work really lived on, and it has been researched in a lot of detail by various analysts around the world, and I went along to look at it in great detail and understand how it would relate well with the wave structure. And that's what allowed me to come up with my own theory of how to put the two together, and that's what I have done in my work on the Indian Kondratieff cycle, which you find on the website. The Kondratieff cycle by itself is defined to have 4 seasons. It starts from the bottom when an economy starts to build, and they call that the spring. It can last for a long period of time, 20 years, 30 years, and that at the end of which it hits a plateau, a period of recession or consolidation in the economy, which is known as a Kondratieff summer. It's often called a plateau because prices tend to go flat for a long period of time, and at the end of that, as things stabilize, which is essentially inflation and interest rates, which tend to shoot up at the end of spring due to the expansionary phase. Once they normalize and stabilize, and it starts looking like you have control over inflation and interest rates, low interest rates usually lead to the final leg, which is the autumn bull market, which is a powerful speculative bull market that ends at some point, typically 10 years, but as we've seen in the US recently, 20 years. And after that you end up in a winter which requires the unwinding of the excessive financial creations of the past period, and then the whole cycle repeats all over again. This has been seen to repeat over and over again over hundreds of years, but when you study it in history, you probably feel that okay, it just happened and you put a time to it, but as we live through it, we are seeing over the last decade that it can take years for an autumn to end, a distribution pattern to form, and a winter to unwind. And sometimes there's a huge lead lag between the stock market and the economy itself. The stock markets can bottom much before the economy, and if stock markets or stocks have fallen very sharply, it's possible that they bottom years ahead of the economic cycle itself. But however, an understanding of how both confluence each other is really important. And so I take you to the next important slide, and that's this one, where I try to align the super cycle degree wave count with the economic cycle, and what I show here is essentially at a super cycle degree, the spring is wave 1, which lasts for several years. In some cases you might have an early wave 1 and a very deep wave 2. That's also possible. And the entire third wave would also be a part of the spring. So basically, wave 1, 2 and 3, the early halt, because wave 2 sometimes the economic cycle contraction the economy can continue to contract all the way into wave 2 even as the markets are recovering, and it's the third wave where everything seems to be doing well, and the spring usually ends with the third wave. So the summer plateau in the face of high interest rates and inflation essentially occurs at the end of the third wave and marks the fourth wave correction of the market, a complex corrective period that can last for several years, that will end once you have stability in interest rates and inflation and the economy again starts to pick up, eventually leading to the final autumn bull market. And followed by a winter corrective period that can again last between 5 to 10 years before you start the whole process all over again. So when you read my writings on India's Kondratieff cycle and you see that I'm marking winter, what I'm really saying is that the 1990s in India was a summer where you had high interest and inflation, and both of them cooled off all the way into the late 90s, and that's when the economy actually picked up after 2000, 2001, and you ended up with an autumn bull market which lasted for most of the decade, and we need to be looking at a winter. So that's the context in which all of those articles are written. There are various factors that measure the cycle which I cover in those reports, so you can simply go read and look into them. The second part which I worked on, and this was early on, I theorized almost more than 10 years ago as I was spotting the bottoming of the previous bear market, that there was also a similar linkage between the fundamental cycle that you see in individual stocks, and that's what formed the basis of what I call the value wave analysis. Now, if any of you have really read Elliott Wave principle, you will find this chart in the book. I'm not saying a specific page, and this highlights how the wave structure really reflects fundamental changes in the economy, and it can actually be applied to how it reflects those changes in individual stocks as well. And it gives you an idea of what is the broad psychology of the wave structure, and what the book calls it is the personality of stock market waves. What really happens is at the extreme bottom, of course, there is a great pessimism, and then you get a rebound, which is an impulse, which we end up calling wave 1. Now, many a times the economy or the fundamentals don't always bottom at the bottom of wave 1. They may sometimes, they may not, and you get wave 2, where sometimes things are as bad or worse than they were at the bottom, and that is why there's still a great sense of disbelief among investors at that point as to whether the overall trend has changed. However, the market itself ends up forming a higher bottom at that point, and that marks the beginning of an expansionary phase into wave 3, and once wave 3 is set in, then you get the best fundamentals, best strength, best breadth, and everybody believes in what's going on. So that's a very different time period to be in, and everything works. And then you get a surprising disappointment in wave 4, which ends up being a correction which is very different from what happened in wave 2. If wave 2 was steep and downwards, wave 4 can be elongated time wise and sideways for a long period of time, and it definitely marks the end of the best phase of growth. However, it doesn't mark the end of growth itself, so it leads to a pause in prices, and after that you end up with a final advance, which is in wave 5. There are usually some fundamental deviations between wave 3 and wave 5. In my sense, sometimes it could be in the form of a slower rate of growth in the economy. If it's a stock, it could be a lower margins, so you have continued earnings growth, but you have a contraction on margins going on consistently, and those are the essential characteristics of what you see in fifth waves, and that marks the final advance before it ends. So putting it into perspective for stocks, after having headed research, looked at doing a lot of bottom up analysis on stocks over the years, I was able to put it in this context that essentially all your value investing and value buying occurs in wave 1 and wave 2 of stocks, and at that point, essentially you will not find any fundamental analyst who's convinced about the stock itself. I have made that attempt to actually get someone to look at what's the fundamental story on a stock in when it's actually in wave 2, and usually they come back with nothing or even disappointment. But if you're someone who's well tuned to understanding value, if you know how to read a balance sheet and you know that this company is worth something, then that's, and if you can see wave 1 and wave 2 structures, then I think that's the point where you're in the early stages of value buying. By the time you're into wave 3, you have great growth happening in those stocks. The story starts playing out, and what starts at growth at reasonable prices continues till it becomes growth at high valuations. As momentum picks up, everybody latches on to the story and valuations get overpriced. And then you get your wave 4 correction. And finally, because growth still continues, it doesn't really end there. You get low growth, high valuations, and sometimes, like I said, you will see some deterioration in the underlying fundamental factors. They could be a reduction in margins, they could be a blow off in valuations versus reality. Some fundamental deterioration of some kind of a particular kind occurs in wave 5, either due to bubbling up or due to simple underlying factors changing for the industry or for the particular stock. However, it continues to move up because earnings continue to grow, but that doesn't last forever, and then you get the deep corrective phase, which can be an ABC correction. In stocks, this entire cycle can vary in terms of time, whether it's going to be a full super cycle or not. Really depends on how big the company is, how big it becomes as part of the economy. The really big ones, the high market cap ones, could actually follow the entire super cycle if they've managed to survive the entire economic cycle of the country. However, other companies that are in growth industries that come in between could have a very different time cycle through which they go through this process. It could be 15 years, 20 years, through which they could go through an entire 5-wave advance and an ABC contractionary period, and then the whole thing could repeat all over again. But you need to study these factors in combination to really know where the stock is as part of the overall long-term structure. With that, you have a complete insight into the basic Elliott Wave counting method, its application to long-term economic cycles, its application to underlying fundamental research, and on that basis, I had put out this chart in the Indian Kondratieff cycle context originally when I first wrote it in 2013, and had marked the end of the third wave and fourth wave between all through the 90s and the fifth wave after that. And at that time I thought that probably the period 2010 to 13 you'd probably be in a deflationary period. Now, if you actually look at the way stocks have performed since that time, definitely they've lost a lot of ground. However, the indices continue to hold up, and the reason for that, as everyone knows, is liquidity. And what liquidity is doing is it's churning in and out of stocks, and that's what I mean by that is it's moving from one to another. So if you think that this is bad, you sell this and buy something else. If you think that is bad, you sell something and buy something else. And that's leading to a narrower and narrower list of stocks that buyers are getting into, especially where money is being churned rather than moved out of the market. And that churning is leading to a narrow list of stocks, which many of which are part of the index. And that is why the index itself does not reflect what has happened so far. Will it at some point of time, or will you really end corrective deflationary period without it? I don't know, and I'm not sure whether I can have a perfect answer to that. We definitely hope that it does reflect what is going on before you start another cycle. However, time-wise, since we are already into 2013, my sense is that it probably takes a little longer. How long? 2014 may be a good time, or will it go on all the way to 2016, which is what a lot of time cycle studies, at least for world markets, were forecasting for a long time, that those trends would continue to 2016. So that's something we'll have to watch on an ongoing basis, but it's definitely extended in terms of time beyond what we were expecting. So that's all in this video, and I hope that allows you to enjoy your India charts experience even better with the understanding of Elliott Wave and all the cycles that are involved, and go with it. Thank you.